The broadcast is now starting. All attendees are in listen-only mode.
Hi, good afternoon, and welcome everyone. My name is Aubrey McLaughlin, and I'm the Director of Alumni Professional Networks for the University of Maryland Alumni Association. We're excited you're able to join us for today's webinar, Is Venture Capital Money Right for Your Company? Presented by Deepan Parikh, 2007 graduate from the College of Behavioral and Social Sciences. This webinar is part of the Alumni Association's Professional Development webinar series, in which we hope to provide thought-provoking and valuable content that will help alumni like you achieve personal and professional goals. We have a lot of information to cover today, but we will be taking questions throughout the duration of the webinar. Feel free to submit any questions you have at any time using the question box that's located on the GoToWebinar control panel. Deepan is a partner at Courtside Ventures, an early-stage venture capital fund backed by Dan Gilbert of the Cleveland Cavaliers and the WPP. Courtside Ventures focuses on investing in technology companies across the sports, media, and gaming verticals. Deepan has led several of the firm's investments, including Beam, which sold to Microsoft, The Athletic, and Fan AI. Prior to Courtside, he was partner at Interplay Ventures, a New York-based incubator and early-stage investor. He also co-founded NYVC Sports with the mission of bridging the gap between sports leagues, teams, investors, entrepreneurs, and media companies. Deepan started his career as an associate at UBS and earned his bachelor's in economics here at Maryland. And just earlier this year, Deepan was listed by the Sports Business Journal as part of their 40 under 40 list. And now we will get started. Deepan, take it away.
Great, Aubrey. Thank you for having me, and great to be on here and start a conversation with everyone that's already joining. And so, when Aubrey and I had first connected, we were discussing, various topics from my experience at Courtside and prior to that, and what might be helpful to the alumni community across the startup world, technology world, and one area that we see a tremendous amount of kind of interest, intrigue, and quite honestly, just a lot of misnomers and misinformation is around raising venture capital money, the benefits, who's it right for, who's it not for. We read a lot of stuff in the press these days where VC money is touted as being this amazing thing and really a sign of success. But the reality is VC money, whereas it is quite necessary for a lot of companies to grow and be successful, it is by no means the right type of capital for a very large majority of companies. And there's nothing to say that you cannot build a wildly successful business without either not raising VC money at all, or not raising until your business is further along, generating fairly significant revenue, have product market fit, and are in a stronger position of strength and leverage. And so wanted to kind of dive into that a little bit today, and happy to have follow-up conversations as anyone is interested to learn more. The one thing that Aubrey and I are discussing, would love for this to be a very interactive conversation. So any questions pop up as I'm speaking, please feel free to chime in. The deck itself is not extremely lengthy or have a tremendous amount of content on each slide, but we'll talk to each one. And I'm also going to share another presentation alongside this one after the conference call, and that way people have a few pieces of information and resources that they can kind of tap into as they're going through this conversation decision-making process of where to raise capital, if any. So with that, I will kind of dive right into it. So topic for today, as we discuss, is VC money right for your company? Kind of just diving right into the first slide here. This came from one of the really well-regarded VCs in this space, Mike Maples, who has spent years and years investing in the across Silicon Valley, across really the world. And he starts off one of his really well-known presentations, which I'm going to share after the fact. And he says, not all VCs are universally liked, sacrifice less than founders, and often overpaid, only 3% of VC partners generate greater than 3x return in their careers, but almost all of them get rich no matter what. There's not nearly enough diversity in the VC business, and this presentation is a couple years dated, but that's still the case today. And truthfully, a lot of VCs probably wouldn't succeed if they had to go run those companies alone. And the moral of this is VCs are often wrong and miss great opportunities. I mean, there are a whole slew of really amazing stories of people that have passed on, stuff like Airbnb and Uber, and it's part of our job. I mean, the best advice I got on the venture space when I first joined was the faster you get over the fact that you're going to miss a billion-dollar company, the better the investor you'll be. And so, that's to say that opportunities, just because an investor passes on your business, it has no bearing, in my mind, on the success or the capabilities that you have in building that company. It is simply one source of capital. And if one VC doesn't invest in you, perhaps others will. We, even at Courtside here, have passed on a handful of companies that have gone on to be incredibly successful. And so, this kind of lays the groundworks to say that VCs don't determine success. So any questions on that? I'm happy to kind of go slide by slide and have questions, but wanted to lay that out there first.
And again, if you do have questions at any point in the webinar, we do have a question section in the GoToWebinar control panel. Deepan, it looks like right now we are free of all questions.
Great, thank you. Awesome. So what's the value of a VC at the end of the day? So providing financing for high growth companies, generally that is pre-revenue, pre-profit, and not generating a whole lot of cash. Seems counterintuitive, right? To give money in the traditional sense of the word to a company that is not generating any profit. This is also why a lot of the venture-backed companies that we see are predicated on technology or IP. And the fact of the matter is, to build out that initial technology, to build that initial, moat or barrier to entry, it requires cash. And once you've reached that product market fit kind of point, the more cash that you put in should generate a higher barrier to entry, a tremendous amount more market share, and over time being able to really win that industry vertical, so on and so forth. And so that's really the financing piece of it. But on the VC side, capital is quickly becoming a commodity. There are a tremendous number of funds on the early stage side, everything up from angel to seed and A, and certainly a whole plethora of investors as you look later stage, from mutual funds, large venture funds. Everyone has their own kind of unique value, but beyond the capital, really early stage investors are involved in the assistance of helping create, think through, and develop new products, right? So understanding just through the experience of an investor, what has worked previously, how does a customer ultimately think about a product, what does the product need to look like to attract a certain customer. A lot of those things are quite pivotal and a large part of where we can be helpful in the early stages of companies. Helping from a managerial side. So our fund in particular, we are not necessarily hardcore technical backgrounds. My partner is, but we're not getting into the weeds of the code base and necessarily helping out from that front, and we know that very clearly. So a lot of times we are backing founders who are technical in nature. And not to say all companies we backed are technical in nature, but a lot of times they are, because it allows them to build an initial product, after which we as courtside and investors can help figure out whether there's a place for that product in the market. That's one piece. Involvement kind of over the life of the company, certainly from 0 to 1, but also from 1 to 5 or 1 to 6 until companies really reach their next few stages of financing. So we're heavily involved on the seed and Series A piece, and then we still remain involved in companies in the Series B, C, so on and so forth. But they're investors who certainly are more tailored and more experienced working with later stage companies, who generally get involved and help grow that company, call it from the 6 to 10. And that participation can be in the form of various means. It could be everything from helping on the hiring front, helping on just thinking through market strategy, helping with distribution and commercial deals, trying to just think through if they're entering a new vertical or entering a new industry or new business model. How does our experience, how does our network of strategic LPs in our fund benefit them to grow and build a bigger company? And really, what VCs are paid for and why we're given money by LPs is to take an inordinate amount of risk. We are, certainly if you look at the success rates of venture investments, it is very low. So as things are as kind of the turnover of companies over time is fairly high, the expectation is that if the company is successful, that it's going to reap significant rewards and a very large potential outcome. We are long-term investors. So on the venture side, perhaps you can get lucky and have a pretty quick exit early on, but cycles of our funds are generally 10 years, with the kind of short end of that being a couple years, depending on how the company is performing, if there's an early exit, all the way up to companies that have far surpassed 10 years. And LPs are in this for the long game as well, knowing that, and this is a bucket that they consider to be a very high risk, high reward. So they expect a fairly large IRR and return if things are going well. So that's kind of just speaking about the VC side. I did realize that I probably didn't give you guys enough of a context. I should have done this in the beginning around just courtside's main focus and the verticals we look at. So Aubrey gave a great background kind of courtside itself. But where we really focus at courtside, so we have two investors, as Aubrey mentioned. One's Dan Gilbert, the other is WPP. But we focus on 4 verticals in particular. One is digital media. So looking at different types of digital media, early stage opportunities. Next vertical is fitness, wellness, and athlete performance side. The third is esports and gaming. And the fourth is betting. So really technologies, services, really any opportunities that fall into one of these 4 verticals, that's in our sweet spot. So before we move on to the next slide, doesn't look like there are any questions here, but I guess if anyone has any questions that haven't posted it here, just let me know, otherwise I can keep going on. Okay, so this is something that definitely wanted to focus on. As there's just so much written about Silicon Valley, written about tech startups, $50–60 billion valuations, a lot of what's been dragged in the mud is this whole term of a lifestyle business, or not taking money from a VC. It's kind of looked down upon. And the reality is a lot of that's just a buildup of the media and what we read. It's very rare we hear of a company that hasn't raised a tremendous amount of capital or doesn't have a whole bunch of sexy investors that goes on to be worth billions of dollars. But the truth of the matter is, lifestyle business or not receiving money from a VC is not a negative connotation by any means. Majority, a very, very, very large majority of businesses never end up raising venture dollars. And a tremendous number of very successful companies have either not raised venture dollars upfront or at all. Look at 3 examples which we laid out here. One, Shutterstock, folks are familiar with. On the photography side, you have Spanx, which Sarah Blakely created, which is a massive brand. And then you have Nike. Obviously, Nike's publicly traded now. But if any of you have read Shoe Dog, which if you haven't, I highly recommend that book about Phil Knight, you'll see that Nike didn't raise all kinds of venture dollars up front to get started. And they built it initially, obviously with, I'm sure, some luck and a lot of kind of market trends alongside it. But they built a business from scratch without having to give away a lot of that company or rely on investors from the get-go. So, I think this is a really important term of just laying out the foundation that not receiving VC money is by no means a negative connotation or a sign that the company will not be successful. It is just simply one form of capital. So, the next few slides we're gonna, dive into understanding just how do you determine if a company should go after raising venture dollars versus maybe other forms of capital, whether that's debt, friends and family, bootstrapping through your own resources. But the number one point that we generally focus on is around market size, right? So if you look at the sizing of the actual market, and we'll get into this a little in the next slide, but small outcomes or cash flow focused businesses, by the way, cash flow could be $20 to $30 million in profit a year. It could be a chain of restaurants. It could be, a really profitable services business. Could be an agency. A lot of times those businesses are either bootstrapped, some initial dollars are brought together by friends and family of the founders, or you go through traditional means such as bank financing or others are collateralized against assets. Now, obviously you don't want to mortgage everything on it. A lot of times people defer to raising venture dollars or outside or friends and family capital as opposed to taking on debt just because you're far more on the hook for it. So small outcomes, and when I say small outcomes, I don't mean 1 million or 2 million. A lot of times VCs are looking for billion-dollar outcomes. And a lot of funds, if they don't see a B next to it in terms of their assessment and diligence that they do, they'll pass. And I think we're a smaller fund, or funds 35 million. We've certainly invested in companies in the past where we don't know or fully believe that they're going to be $1 billion outcome, but it's all dependent on how early we get in. If you get in at a company that's valued at 2 million but sells for 200-300 million, that's a pretty darn good return. If you covet at a company that's worth 50 or 60 billion from valuation side, you have to really believe that it's going to be a massive outcome. So early stage investing is obviously very different in terms of the way in which diligence and kind of the decision-making process is made. The second tier here is kind of unknown outcomes, right? So before you know whether there's an actual willingness to pay for your product, before there's product market fit, before you know if an industry is really going to take off, for instance, or whether the market is large enough, a lot of times people go directly to the same route, which is bootstrap, friends and family. And then as the product kind of progresses, as more information is gleaned, they move towards VC. And then kind of large outcome, meaning building really defensible type technology, building marketplaces, having proved the demand in market, or simply going after an industry that's just incredibly large and fragmented. A lot of times that's where people come in and raise VC or growth dollars. So kind of determining market size. From an investor's perspective, this is probably one of the more poignant kind of things we focus on when we're speaking to entrepreneurs. One very honest feedback that I would give to anyone is if you come in and you're pitching an investor, doesn't matter if it's a VC, an angel, friends and family, if the first thing we see is that you're going after $1 trillion market, we automatically discredit and treat it as a red flag. That to us means that you don't have a full understanding of what your actual total addressable market is. The big thing here is that understanding how to calculate, what your TAM, their total addressable market, looks like is really important. So let's take a $1 trillion industry. Of that $1 trillion industry, what part of that can you actually go after as your company? After that, let's take the best penetration rate, a really practical penetration rate. What does that number look like? That's really what people are investing in, because that is the number which ultimately you feel, the investors feel, is attainable if all things go well. So kind of this whole notion of overselling the market size, thinking that, the bigger the number, the more interest there'll be, I think is absolutely false. I think you have to come in with certainly a large number, but one which is practical and one that is actually achievable and feasible. And if you can't get to that number, it may not serve you well to actually go try and raise venture dollars. That probably means the market size is too small, or simply too fragmented, or too, dominant by some incumbents in order to actually go after without having to raise hundreds of millions of dollars. And then, this next slide talking about kind of doing the math. So when we look at the economics of what a founder ends up with, one really important thing to think about is dilution. So I'm certainly not saying that everyone needs to be dilution sensitive. A lot of times in the early stages, giving up quite a bit is what it takes to bring in outside capital. And the average kind of percentage dilution that we see per round is, in the range of 15 to 25, with the average being 20-ish. If the company is really hot, you get down to 10 to 15. If the company is fairly early and still unproven, you may get all the way on the upward bounds of 30, but probably goes through 20, 25. And that's each round, right? So if you're a company and you go raise a significant amount of capital over time, sure, the market value of your company is continuing to grow, but you may end up at a point when you're at a Series D, even a Series B, and you own 15% of a company, maybe 10% of a company. And that's fine, by the way. That's totally digestible if the pie is continuing to grow. But doing that math versus, let's say, building a company that doesn't require outside capital. Let's say a company you own 90% and sells for, call it 20 million bucks. It's a lot of capital coming to you, right? You got 18 million bucks. In order for a company where you raise a tremendous amount of capital, if you own 10% of the company, you got to get to $180 million exit. So, doing that math and understanding that we've looked at companies that we absolutely loved in the past from our fund. We were really honest with the founder and we said, we are not sure if this company is going to be a massive, massive outcome, but our really strong recommendation would be not to raise capital at all, or don't raise very much capital, because you will end up with more of this company and ultimately with a larger payout than you would if you tried to go raise a lot of money and ultimately don't hit, this huge exit mark. So that's something to think about. Also, with venture dollars comes a lot of governance. And, at the end of the day, VCs, we are stewards of LP capital, and we have a fiduciary responsibility to our investors in our fund. And as part of that, that means that we and all VCs, a lot of sources of capital, have quite a bit of say on the governance side. So from board seats, having to hit a lot of metrics, having to, once you take outside capital, it means that you as the founder obviously are still the lifeblood of that company. But if things don't go necessarily well, there's a chance that you may be out in running that company. And that's happened a number of times, not necessarily in our portfolio, but I'm sure you could read about it for days. And so, that's something to think about. Also, lack of flexibility. When you're running your own business or a company that doesn't necessarily have the ties to the venture dollars, you have more flexibility. You have the ability to shift into different verticals if you see fit. If things maybe aren't taking off in one particular area or not, you can be far more nimble in the way in which you're building, scaling, growing, hiring on that team versus the other way around. So just these are all things to really think about. And a lot of times, truthfully, one thing that a lot of founders don't think about is when you raise money from outside investors, even if it's friends and family, you have a responsibility then at that point to see that through, right? You can't say in 6 months, I mean, you could say in 6 months, you know what, this isn't working, I'm just going to shut it down. Doesn't necessarily look very well, one, to the investors who spent quite a bit of time and gave you money to either say, hey, here, we're giving you 50% back, or, we spent all the money in a short period of time and we're out. It's going to hurt your reputation pretty heavily. So I think, you got to think really long and hard before you take capital if it makes sense and if you're fully dedicated to it and you really think that you can spend a good 5, 10, 15 years in potentially building this out. Finally, I think the one thing that a lot of people try to raise on externally, but doesn't necessarily pan out that well, is on ideas. I mean, we get pitches nonstop where folks have ideas that they want to raise outside capital, but they haven't executed or built anything yet. And so, this seems I'm sure very simple, but the fact of the matter is ideas are genuinely useless. Having an idea obviously is the foundation of being able to build something, but the reality of an idea is that if you have an idea, there are multiple other people out there who likely have the same idea or something similar that are working to build a product against you as well. And so, you obviously, one point I would highly stress is before going in to raise any form of outside capital, whether it's even friends and family, if you're able to spend even a tiny bit of your own capital, and I mean a couple $100, to just validate some initial proof points as to what you're doing and the value behind those proof points to showcase that there really is a market opportunity, I would say that that's invaluable and probably would lead to a lot more fruitful conversations and less spinning wheels. So I guess that went by fairly quick, but that's what I had prepared in terms of the deck. I do have some other stuff I'll send you guys, but love to open it up to questions and maybe even understand who's on this call right now. Is it mainly entrepreneurs? Is it other investors? Love to kind of get a gauge for that. So if anyone has any questions at all, love to see if I can answer them.
We'll take just a couple of minutes here. If you do have questions, to type them in the question box. You can also feel free to use that question box to type in what you are. If you are an investor, if you are starting your own company or organization, or if you're really just looking to get more of a general knowledge about VC money, we'd love to just know a little bit more about the audience. Deepan, looks like we do have a question here. As an entrepreneur, what were some of your biggest challenges of raising money?
Great question. Yeah. Everyone faces obviously different challenges as they go through in raising capital. We had a couple big challenges. One, we were trying to sell our product to a very unknown customer. So at the end of the day, we were actually selling to pro and college sports teams in the company I was running. And the biggest challenge, we assumed that there's so many sports fans out there that this would be a no-brainer product. We didn't do a very good job of validating our actual findings and our kind of hypothesis to a point where investors looked at it and said, yes, they actually know that there's an end consumer who's going to pay for this product. And so kind of selling that vision was a really big challenge. Second was, I wasn't technical at the time. My co-founder at the time was not technical either. So really trying to raise capital with two non-technical founders was an incredible challenge. We were really fortunate where we ended up having bringing on 2 engineers who are wildly talented, and that really helped us get to the next stage. But up until that point where we had someone technical, or at least an initial product built, it was a really big challenge. And one thing which I mentioned in this deck, which we didn't heed the advice of, and I wish I did sooner, was around the total addressable market. So we were selling to sports teams. Ultimately, at the end of the day, if you look at sports teams, including the top colleges in the US, it's 160 total customers. That's a very limited market size. And so kind of going into a lot of the conversations, the first thing people said, or investors said, was, why do you think that you can build a large scale company when today your total customer, best case scenario, total customer base is 160 customers? So I would say those are my kind of biggest challenges when we were raising capital.
Great. And then another question came in as well. As an aspiring entrepreneur, can you expand on what are the elements of proof points and validating them in order to have investors on board?
Yeah, so I think it obviously varies in terms of the types of investors you're going after. If you're going after seed stage, early stage investor, really what we're looking for, obviously depending on either if it's consumer or on the B2B side, is consistent growth. So seeing that 20 to 30% month over month or even week over week growth of your product, even if it's on a small base, I think is incredibly, incredibly powerful. So I hate using the word traction, because I'm sure anyone who's ever pitched an investor has heard traction as kind of being this kind of end all be all of what it takes to raise capital. But I think if you focus on, every day of the week, I would take an entrepreneur who's figured out, even with a small base of users, how to, one, keep them happy, two, how to keep them engaged on a either daily, weekly, monthly, depending on the type of product, and three, getting real genuine feedback from them to understand how to improve, and do those people turn into really key kind of customers for them down the road. So, I would say, again, like from a validation standpoint, I think consistent growth, even amongst a small group or a small cohort, is incredibly valuable. And obviously, I think the most important one is, if it is a paid product, the willingness to pay, and some initial churn figures to say that people are willing to pay over time is really important.
Great, thank you. I think we have wrapped up all of the questions we have so far.
Okay, cool. Well, I certainly don't want to cut things short here, but if there's any other questions that you have, I know, Aubrey, the last slide here you can kind of see is my contact info. We'll be sending out this deck afterwards to everyone who's attending. So if there are any further questions you have, perhaps that you don't want to ask here, you just want to email me, I'm always happy to have a conversation, always looking to help out fellow Maryland alums. Stone Aubrey had a handful of folks that really helped me out through the whole process as I was kind of working on my own company and then on the venture side as well. And one thing about Maryland alumni, there are a lot of Maryland alums that are in really powerful and really successful positions, a lot of which are willing to spend time with young, hungry entrepreneurs, or just people who have either recently graduated or been out of school for a while, who are just looking to make a shift. So if I can ever help with anything, just let me know.
Thank you, Deepan. And I'll just add to that as well. So at the Alumni Association, we're actually in the final stages of launching our first ever industry-based networking group for alumni. So it's called the TERP Entrepreneur Network. It's designed for alumni entrepreneurs to connect with other alumni entrepreneurs all over the country. And so connect with one another, learn from one another, and hopefully expand your business connections in this space. I will be sharing more details about that group and about how to get involved or how to start receiving communications. That group is going to be launching in the middle of October, so we're very excited about that. So you should start to see events and opportunities and programs surrounding the Entrepreneur Network as we get into 2019 and beyond here. So Again, I will be sending out Deepan's contact information with this follow-up email, along with a recording of today's webinar, so you can refer back to it. Deepan has graciously offered to share his slides as well as the other presentation that he mentioned earlier for us to share with all of you today. So I'll be sending that out as well. And feel free to contact him directly if you'd like more information or want to discuss your own individual situation and hopefully begin that relationship and that connection there as well. Deepan, it looks like we've covered all of our questions today. Just any final words here from you before we wrap this up?
Yeah, I mean, look, I think the first slide really summed it up, which said the journey of an entrepreneur, I think, is far harder than that of the investor. So don't treat the investor's word simply as the go, no go. If you feel really passionate about building a business, stick with it. I would say there's a big difference between being passionate about something and then really proving out that passion if there's a real opportunity there. But I would say stick with it. And, there are a lot of different forms of capital. And if I can ever be helpful with anything, please just let me know.
Awesome. Thank you so much, Deepan. Thank you so much for hosting today. Big thanks to everybody who was able to join us today. Have a wonderful day and go Terps.
Awesome. Thank you, Aubrey.
Thank you. Bye.
All right. Bye-bye.